Hello, everybody. Welcome. It is Power Hour time. Thumbs up if you guys can see my screen. I'm sharing my screen. We have a very special guest today. So just going through some admin stuff, though. This is the Power Hour webinar offered through Tax Plan IQ. We are going to be discussing today cost segregation. And Heidi is a very awesome person. That's a great presenter, so I'm really excited. Let me give you guys more detail on her. Oh, before I do that, just intellectual property notice. This presentation is prepared and is the property of Tax Plan IQ. Any images and impressions protected under U.S. intellectual property. I have to say this. It's our lawyers make us say this. So reproduction and dissemination of this is prohibited. So I'm Veronica Herrera. I am the tax technical manager here at Tax Plan IQ. Many of you guys may know me, have seen me through meetings, presentations. So really happy to be here and to do this PowerPoint presentation. Sometimes it's Jackie, Dave, myself, being the part of the CPE. We love meeting with all of you guys, giving you guys, presenting the most up-to-date information on tax strategies. So Heidi, tell us a little bit more about yourself. You are with Engineered Tax Services. You are a preferred vendor of ours, which is awesome on a few strategies. So yeah, you want to kick it off and tell us a little more about yourself?
Of course. Yeah, thank you so much. I'm always happy to be here. You guys are amazing. I'm such a huge fan of Jackie and your team. I have been with Engineered Tax Services now for 13 years. I am one of the partners, and I've spent 28 years in tax and consulting. I have a master's in tax, and I've really always been in the real estate space. I was a controller for a resort based in Utah. I now actually live in Las Vegas, and really have been in consulting, like I say, about 14 years, really looking at tax strategy, tax credits and deductions. And so Engineered Tax Services, of course, specializes in cost segregation, R&D tax credits, and a number of other strategies. So we are such a huge fan of Tax Plan IQ and the technology that you guys have developed. So really excited to be here and work with all of you guys and hopefully be some support to you and your clients that have real estate and are looking to utilize all the tax benefits that associate with us.
Yes, well, we're happy to have you here. So I'm just gonna, this is a Power Hour on cost segregation. You're gonna go over, the details of what, the opportunities, risk, implementation, checklist, correct? And so I'm just gonna hand it over to Heidi, and then we'll periodically stop for questions. If you want to put your questions in the Q&A box, we'll periodically stop and answer those. And then, as you have questions or any answers or any feedback, we would, periodically stop and check those. Okay. This, as Julie mentioned, today's session will provide CPE by CPA Academy. You must be present for the whole session to receive the CPE. Okay. So on that note, let me turn it over to you, Heidi.
Okay, sounds good. So let me get my PowerPoint up here. It takes just a second to I've got a couple of screens, so sometimes I've got to swap them around. Just 1 second. There we go. Okay, so I'm assuming you guys can all see my screen and not my presenter slides. But we're going to talk a little bit about hidden treasures as they relate to tax incentives, really looking at cost segregation. This is such a tremendous tax benefit as it relates to those investors buying real estate. As I had already explained, I kind of gave you guys a bit of a rundown, and Veronica shared that slide with my bio. And so we're going to dive right into the tax benefits of real estate. We'll talk about depreciation. I think that most people, in fact, if you want, I do have access looking for my my display panel here, but would love to see your chat comments. Who here is familiar with cost segregation? Who has had clients deploy a cost seg strategy? If you have any questions right off the bat, I will kind of glance at those. I love looking at the chats and the questions, and I will try to be looking at those as we're going and addressing them as we're going. But tell me what your experience is, because that helps me kind of cater our discussions today. As I talk a little bit about depreciation and I talk about how we're going to use the benefits and handle all of those structures, we're also going to talk about utilization, because that's a big one as it relates to how we use depreciation for particular investors, because we've got these issues with passive activity losses, material participation. And so I have some things in there that I want to include in this presentation and hopefully help you guys understand how best to deploy this, how to have that conversation with your clients when they're asking you about cost seg, what properties it applies to, and kind of the extent or optimally the value that could be created by applying this type of strategy. So cost segregation, I actually like this image better. This really is looking specifically at the image of how we define or understand what cost seg is doing. We're looking at that from straight line without cost segregation. When you take a building your client has acquired, typically that's going to be placed under straight line depreciation, which is the most common. And we look at that as being our standard deduction, whether it's commercial real estate being taken over 39 years or residential real estate over 27.5 years. When we're shifting and applying cost segregation, we're taking that from that straight line method and then converting that into figures. So the modified accelerated class recovery system, where we're applying each of the components of the building into those alternative depreciation cycles or useful lives, as the tax code defines those. And those useful lives being how we're looking and deploying each of the units of property that are then applicable with that building, and extrapolating personal property apart from the real property. The way I define it, the easiest way I've found to explain it to a client, real estate owner, is to just explain, look, it's about taking a standard deduction, just like if you were filing a 1040 EZ, versus itemizing your deductions and taking the itemized outline, which you have to have some type of reporting for. If they're itemizing deductions for a home office or mileage on their vehicle, they need to have that support, right? They've got to have that detail and the invoices or receipts to be able to defend those deductions or write-offs that they're going to claim. The cost segregation is creating that detail. It's creating the breakdown of assets so that you have that, and it's much easier to file the tax return with the data to be able to accelerate those depreciable items and take them over a shorter period of time. When we define then what specifically falls into the real property category, IRS code section 1250 versus 1245, personal property, I get this question a lot. Clients ask this question, some of our CPA partners ask that as well, is really what specifically is defined as real property or the structure versus what can be extrapolated and then accelerated through the process of cost segregation. Real property or 1250 property is defined as real estate. It is immovable. It is attached directly to land, including buildings, ponds, canals, roads, certain machinery, and any components that are attached to that are required for the functioning of the building as a unit. I don't know if you all remember or aware of the tangible property regs, but when those came out a number of years ago, gosh, I think it's probably been 10 years now, the tangible property regulations really define the units of property, and also then said that the IRS wants to better understand the unit of property for real estate, so that when we're looking at improvements, we're saying, how are we going to define if something is a repair cost, if it falls under routine maintenance, or if it is in fact an improvement, which then would be capitalized. And so the purpose of the cost segregation study, aside from just accelerating certain assets, had a dramatic benefit with defining the units of property within the 1250 property structure itself. So we have our standard categories, our 39 for commercial properties, or actually short-term rentals are also 39-year property, or 27.5-year for our residential rental properties, long-term rental properties. Within those systems, we also then have the units of property, again, really defined within the tangible property regulations that the IRS issued. The property really being windows, walls, doors, roof, concrete. That is kind of our structure. But then they also include our mechanical, our electrical, and our plumbing systems. That's important because a lot of people, if you have a client that's asking you about cost seg and what is it that we're extrapolating or kind of reclassifying, they'll always ask this question. They're like, well, yeah, because I always have to replace my water heater or my air conditioning units. And so, yeah, I want to be able to write that off. But those systems, water heaters and HVAC and air conditioning units, those are actually part of the mechanical systems. Those are structural. They still stay within the 39 or 27.5 year categories of real property, because those are part of those 9 units of property defined in those tangible property regs. So outside of that, then we look at essentially what defines personal property and what can be pulled out or drawn out of that personal, out of the real property category 1250 into the 1245 category. Personal property being furniture, fixtures, and equipment, carpeting. In addition to carpeting, probably the most common one we see now is luxury vinyl plank, LVP flooring. That is considered non-permanent. We look at also decorative lighting, electrical costs for phones and data, and then components that are integral to the manufacturing or the production that is being done within the building. So then in those properties, when we're looking at, say, a manufacturing facility, a big one is a dental office. We'll call it dental offices or a veterinary clinic. Buildings that have a lot of electrical and water and mechanical systems. However, those systems are very unique to the functioning of that building. So if it was just a, let's call it an office building, some of the specialized items that went into that, including, again, electrical, water, mechanical, those things are specific to the business that is functioning within that space. Therefore, even though it's part of the larger electrical system, we can pull out and extrapolate parts of those systems which are specific to the business itself, aside from the building. So when we look back at real property and understand that from a units of properties perspective, and we're looking at mechanical systems and electrical systems, yes, those are real property, but we look at the use of each one. So this kind of comes back. We have clients also ask us, why is a site visit necessary, or why is a study required to be able to properly classify assets? Well, because all assets are not created equal in every building, we have to look at the case and the scenario of how it's being used. There is a quote that says it comes down to what assets are related to the operation of a building versus what assets are related to the taxpayer's business. Therefore, you may have an electrical line and a light fixture in one building that is all 39-year property, but that exact same light fixture itself may be personal property in a different building, depending on the installation, depending on the other lighting and electrical systems around it. Thus, the importance of doing physical site visits, really digging into the why behind the assets, and not just making assumptions or using like statistical sampling assumptions that may be applied in some scenarios. So we highly recommend a more in-depth study and making sure that site visits are performed so that we're seeing those assets and being able to outline those correctly. We love the phrase, we are defensively aggressive. We want to capture everything that we can for the client, but we always do that from a defensible standpoint. In this property, I like this home. We actually do a tremendous number of single family properties. I would guess, raise of hands or comments. Do you have clients now that are buying short-term rental properties? We have seen such an expansion of professionals, individuals who are pretty high income earners looking at strategies that they can deploy to help reduce their taxes. And the short-term rental aspect has become a major incentive for those individuals. And I actually have a little bit in here about the short-term rental loophole. So we'll talk a bit about that further in the presentation. But these short-term properties really have a tremendous amount of benefit from a depreciable standpoint. And in this property, in this particular scenario, certain examples, again, mechanical or electrical systems we know are part of the structure. However, in this space, this is a great example because they have can lights that you can see here all throughout this home. All of those can lights are 30 or 39-year property or 27.5-year property as part of the core structure. They're required for this space to function. If we don't have lights, it's not a very functional property. However, all of these pendant lights, this ceiling fan, this chandelier here, all of those items, those are purely decorative. If you take these out, this space is still completely functional. Therefore, these assets can be accelerated as personal property. But additionally, the electrical lines, and this gets back to really looking at engineering studies and engineering-based analysis, which is our specialty, because not only can we look at these fixtures, we can then also carry that all the way back through the electrical lines to the breaker panels to capture and accelerate those portions that were installed and built for the sake of these decorative fixtures versus just structural components. And that can have a pretty dramatic impact on the accelerated depreciation and how we write those down. So I love that example for this particular property because it's got a lot of fun finishes. One thing I will tell you, and I like to educate our CPA partners on the importance of understanding land valuations. And from a cost segregation perspective, as a cost seg professional, we tell our clients, our CPAs and our real estate investors, we are not land appraisers. So we are not going to come in and assess the value of the land. We do the research. This is also one thing that's unique to us in our proposal process, is that when we run a proposal, we are going to go find the tax card. We will pull the tax card to identify what that ratio is from the property tax assessor. We'll use that ratio in our proposal. That does not always help us on the benefit analysis side because in recent years, we have seen a pretty surprising increase in the percentage that many of the tax assessors are listing for land valuations on many of these properties. Southern California, of course, we see very high land to improvement ratios. Land could be, I've seen them anywhere from 60 to 89%. Interestingly enough, Reno, I have this conversation on a very ongoing basis with our clients in Reno. For some reason, the tax assessor there has decided land is worth a lot of money. And so the average land value in Reno is over 60%, even for newer homes. It's very odd. So I explain this because the land value, when we're looking at real estate, how you are going to place an asset onto your client's tax return or depreciation schedule, the land value is incredibly important. Historically, I'll say 10 years ago, I had many CPAs that just used the 80-20 rule. They said, look, 80% improvements, 20% land, call it good. The problem is we have begun to see an uptick in audits, particularly with the land value that is being used for many of these assets. We also have somewhat recent court cases. There was a court case about 4.5 years ago that came out. There was an audit of an investor that had about 6 properties. They got audited for the land valuations, and the court decided they had to use the assessed value from the property tax card. They had used some arbitrary percentage. And so that is the most commonly used. However, if that is a very skewed number, if it seems unrealistically high, then they certainly can get a land appraisal. You certainly can use a reasonable percentage, but it can put you or the client at risk for audit. And so I will explain, I like to kind of harp on this topic, that we are going to look at the assets and the improvements within that property, but the land valuation, we will pull the tax card number, but then confirm that with you and your client of what value you actually want to use on the property. So please be aware of that and understand when we come back and say, okay, what do you guys want to use here? That's where we're coming from. When we look at buildings, we really consider what is a good candidate for applying a cost seg study. Where does it really fall into the best, I think, the sweet spot in terms of having the optimal benefit? We deal with commercial properties of all sizes and scope in all 50 states. We're dealing with properties pretty much of every size range. I've got it here, on an unadjusted basis of about $300,000 or more. But I will tell you, we do a lot of properties with a tax basis in $100,000, $150,000, $200,000 range as well. We do a lot of residential properties as well as multifamily. We say, look, we can do everything from a short-term rental property in Nebraska to an NFL stadium in New York, which we've done many of. And I think what's surprising in the CPA space is that cost segregation historically was really used typically on very large commercial properties and typically had a very high price range. Even when I started in this space 15 years ago, cost segregation studies on average were going to be $10,000, $20,000+ per property. Today, residential properties are a couple $1,000s, and commercial properties in most cases are less than 10,000. On the standard CVS, Walgreens, even self-storage properties, we may be in the $5,000, $6,000, $7,000 range tops. So pretty reasonable when we're looking at the tax benefits, and then also considering what the depreciation is and long-term value of that client. So just beware that it is highly applicable to really all types of properties. The most important factors when we look at a property is actually looking more at the client's personal tax filing situation. This is why we love to work more with CPAs than we do with clients direct. And that is because we want to have the conversation with you all in understanding what is the client's federal income tax liability, how much income do they have, are they for profit and are they actually paying tax, do they plan to hold the property for more than 1 year, and do they have any limitations as it relates to passive activity or material participation. Many of these clients, although we do a lot to educate real estate investors and educate the space, as I think we're all aware, the tax code is very complex. And we do have a lot of investors that are not sophisticated when it comes to this discussion. And so this is one reason we love partnering with Tax Plan IQ. We love partnering with the CPAs that we work with to work collectively and collaboratively to the benefit of the client in identifying what the opportunities are for them. When we're looking at different property types, we have this question a lot. Again, curious if you guys have questions with your clients where they're asking you, what should I buy? What should I be considering? This is something we get all the time. Once clients start to recognize the benefit of cost segregation, how they can use the depreciation against their income, the question then is, okay, wow, well, now if I buy another property, what should I? Do some properties perform better than other properties? What asset classes should I be considering? That is a topic, again, I have this conversation almost daily with many of our investor clients. You can see on this chart that, from a high level, there's a lot of benefit. At this end, we're looking about 40% reclassification. On the low end, we're still looking at 22% more, and that's even on just a warehouse distribution type property. There's a lot of benefit when we're looking at total reclass. Now, there are some outliers that really aren't reflected in here, but I'll highlight a few because these are the ones these are the ones everybody wants to know about, and also why there's a lot of demand for these kind of properties and investments. Self-storage properties, depending on the construction, but if it is an older style metal building, shed row type construction, those have extremely high reclassification. They could be 70, 80% personal property because those buildings are not considered permanent structures. Therefore, they're treated as 7-year property as equipment. So self-storage properties, there's a lot of demand and interest in those from investors. Mobile home parks are tremendous, a lot of land improvements that can be accelerated. Multifamily properties have a lot of finishes as well. We have a lot of bathrooms, a lot of kitchens and cabinets and other fixtures that can be accelerated. So those perform extremely well. And then other ones, car washes and gas stations. Those sometimes can be entirely accelerated as 5, 7, or 15-year property. And so those could be upwards of 80 to 100% on the depreciation scale. So keep those in mind if you have clients that are then asking you after they've gone through this exercise or interested in being very strategic with their planning. I think that's the beauty is I will make the assumption that many of our audience here is really dealing with clients that are looking at tax strategies, and investing in real estate is such a tremendous strategy, particularly when they're understanding these types of benefits and what properties that they can invest in. When we're looking at those kinds of ones that we're discussing, it's applicable to new construction, to renovations, existing properties, recent acquisitions. It could be something they've owned for 5, 6, 7. It could be something they've owned for 10 years. Cost segregation can still be applied retroactively. When we see large improvements, there's an application to doing improvement studies to capture the benefits there. We also can apply this when we've got a step up in basis. So if there is an inheritance or if there is a partnership step up because a partner bought someone else out in the ownership of a building, there can be a tremendous value in applying cost segregation to that step up. We also apply it in many 1031 exchanges, although the 1031 exchange can only look at the increase in basis. So keep that in mind, that we're looking at when they've taken an older, highly depreciated asset or something of less value, and they've done a 1031 exchange into a property of significantly higher value, that's really where there could be some benefit of applying this type of study. From an engineering standpoint, just to show you some of the details that go into an engineering report and to give you a little bit of background. We know that there are multiple providers in the space. We also know that there are a lot of groups that have come online that are like the calculators, online resources, online companies that are doing a high level kind of stat sampling, or the client enters a few basics of the property and it kind of populates a report or an asset listing. I want to highlight kind of what the differences are with doing an engineering study and help you kind of understand the value of those, both in the immediate application as well as the future benefits that they can apply throughout the ownership of their building, and also the differences of kind of what they're getting, because clients, again, they don't really understand. Cost segregation has become quite applicable. There's a lot of talk and discussion about it, even on social media, we see it a lot. But cost segregation does not necessarily have one specific definition and then just mean that any cost segregation study is the same. They actually can vary pretty dramatically in terms of what the end deliverable is, as well as the ultimate result that the client's going to get from that study. From an engineering standpoint, what we like to see, what we're providing, and you can look at if you're asking for a redacted study and understanding essentially what the end deliverable will be. Number one, providing the CPA community with updated depreciation schedules after the study is completed, so that those schedules now can be then imported into the tax software in a very streamlined, easy method. So you're not having to dig through a report to kind of understand then how to apply it to the tax return. So the depreciation schedules, we love that. Second, a breakdown of each unit of property. So this is the second level. So first, depreciation schedule showing the buckets of 5, 7, 15, 39-year property. The second level being the unit of property that we're seeing within the systems and the real property. And then third, a full detailed list of a detailed asset listing that shows all of the components of the building, including the 39-year assets and all of those accelerated components. And to show you what that looks like, depreciation schedule level 1, level 2 is the unit of property designation. You can see that here. Apologize, I know the text is small, but you can see here unit of property is the building envelope, elevators and escalators, fire protection, plumbing, HVAC, electrical. So we list each of the building systems as a whole. So we have that as one combined system, also reflecting the 5, 7, 15, or 39-year components within each of the larger systems. This actually helps to implement the repair and maintenance regulations, the tangible property regulations, when we're dealing with repairs to a large building. The third level, the depth of the detail that we then find is the actual detail or the engineering that breaks down the assets within each of the components. Again, 39, 5, 7, 15. This is really where the value. My next slide, we'll talk about partial asset disposition, but the asset detail is really where the long-term benefit is reflected for the client. Yes, we're going to get the highest, again, defensively aggressive results because of our approach of diving into all of the building systems, including electrical, plumbing, mechanical systems, and breaking all of the details down in construction. But aside from getting a higher benefit because of the detail, this is really the long-term value that we look at and we see with clients is when we are doing repairs, or I should say improvement or CapEx. The detail that then is included in that allows for identifying partial asset disposition, or understanding what is an improvement versus what is a repair, what is routine maintenance, and how does that apply to the overall unit of property. This could be a whole nother, we did many CPE hours on the tangible property regs, which could be a completely different topic. But the tangible property regs really define how we look at improvements. What is a deductible expense versus what is being capitalized as an improvement. For items that are being capitalized, which are replacing or repairing structural components, they are extending or adapting the unit of property, they are creating some energy retrofits or benefits to the building to make it better, then we capitalize those as new improvements. But when we have that, that results in, or should result in, then a disposition of the items that are then removed. The disposition can include a deduction of the demo costs for labor and expenses of assets removed, and then being able to write off the structural components that are no longer there. If I go back to that previous slide, this is an example. So I have a commercial building, an office building. It was in Utah, a lot of snow, a lot of salt. This weird metal staircase on the outside of the building with concrete treads. And for some reason, I'm sure the salt and the snow just created havoc, and they deteriorated really bad. And they kind of started crumbling. So we ended up having to replace the entire staircase because even the steel was kind of corroding and we had concerns. So anyway, we bought the building. The staircase was all 39-year property. In this case, this staircase with the landings, this is a great example because it just happens to be a steel staircase with the steel pan tread landing. It's valued at $120,000 is what the total cost of this was, and is depreciated over 39 years. If after year 2, that client, in my case, we go remove that staircase and we put in a new staircase, it was like a $25,000 cost or something. We have to capitalize that $25,000 cost now as a new component to the building. It's this new staircase that we've now installed. But this whole section is no longer there. And it would then continue to depreciate for another 37 years. I've owned it for 2 years now. So then the value of this can be entirely written off and deducted in that year that that staircase was removed and demoed. That's the partial asset disposition. Another really common one we see is roof construction, when we see roofing, replacing the roof. Another big one is HVAC, air conditioning units, heating units, water heaters. All of those are 39-year assets. So when those are replaced, the detail within a cost segregation study should give you the detail to be able to find those items in the report and take the remaining deduction, the adjusted basis, and deduct those items in the year that that was removed, and then they replace the new one, which now becomes a new asset you begin to take depreciation on from there. So tremendous benefit, huge opportunity with these studies. We really try to educate our clients on, look, we did the cost seg, we've got this amazing first year benefit, but don't forget, you have this report. It's a tremendous benefit. It's a living, breathing document of inventory. So keep it and use it annually to identify those additional write-offs. So a lot of ongoing benefit. Then we talk about bonus depreciation. So bonus depreciation is like, this was just like a steroid injection for cost segregation. Of course, we've had bonus for a long time, but what happened in the Tax Cuts and Jobs Act was that they expanded bonus to apply to used property for the first time. And that meant that a property owner who bought real estate, existing building, could utilize cost segregation, classify the items that are shorter than 20 years, and then apply bonus depreciation to all of those items. Of course, it's declined a little bit right now. We're at 60% bonus, but this example shows 100% bonus depreciation of what cost segregation looked like before we had bonus. So without cost seg at all, the straight line depreciation is about $64,000 a year for a $2.5 million building. Cost segregation under its standard method, no bonus, was generating about $172,000 in the first year of accelerated depreciation. So 172 was about 3 times the depreciation was the average of what we saw. Once bonus depreciation was applied and approved, that then created this benefit of capturing all of the 5 and 15-year property immediately, resulting in a deduction of about $794,000, again, for a $2.5 million purchase. It's really dramatic because on a $2.5 million building, if a client is putting 20% down, they're putting down a $500,000 down payment oftentimes. If year one, they're getting an almost $800,000 deduction. If they are in a high tax bracket, they are getting a significant amount of their investment back through tax benefits, of course, depending on what their tax liability is. But this begins to show you the immediate return that we see based with bonus depreciation. So it's just really, really dramatic. As it peels down a little bit, 60% for 2024, we have a little bit less year one. It's still pretty significant with 60%. Year two, you actually have a bit of a higher deduction as well because it's trickling over those first 5 years. So it's a lot of benefit. We highly anticipate that bonus depreciation will be extended back to 100%. We are very, very involved in DC with lobbying. We get weekly updates. We have actually seen a draft of the tax bill that the new administration is putting together, and it does include an extension to 100% bonus depreciation. So we certainly expect that for next year, there's a high likelihood that we will have that back. And again, it just kind of reinfuses this opportunity for utilizing depreciation and the benefits of cost segregation. So with that, jumping into active participation versus passive activity, this whole thing, this then ties into what is the taxpayer's opportunity for using the deductions. Can they utilize that against their income? And the questions that we explore really start to look at, is there an opportunity for them to designate someone as a real estate professional? The most common strategies we see today is we have a high earning spouse with maybe a low earning spouse, oftentimes is able to retire or stop working so that they can apply their time to the real estate activities, thus generating the real estate professional status and being able to utilize the benefits for the real estate against the W-2 ordinary income for the high earner. And that's something we work with thousands of doctors and dentists and other, attorneys who are really deploying that strategy. Again, that's the increase we really see in short-term rental properties as people are diving into this, this process of understanding how they can use real estate to help increase their net worth, reduce their tax liabilities, and grow their generational wealth of passive income. And that then leads us into the short-term rental loophole, which on material participation on the previous slide, when we're looking at the real estate professional designation, that's really requiring that the taxpayer has at least 750 hours per year, and more than 50% of their time in real estate related activities. That can be pretty dramatic. I mean, that's about 20 hours a week, so it's a part-time job. They have to be doing that more than they're doing anything else through the year. If they have one rental property, it's difficult to defend that level of work and time to manage one property. But when we get into the short-term rental loophole, we're really looking at this. It is saving people thousands of dollars in taxes because it does not require you to be a real estate professional. It can be found in tax code section 1.469, and it defines the exceptions, which is the exception to the definition of rental activity. So rental activities are standard real estate professional designation, but this is the exception. If we look back at kind of how this has evolved, because we see even many of the CPAs questioning how is this possible, and a lot of individuals really getting up to speed on using this strategy. But in 1986 is when they passed the passive activity rules, because they recognized that taxpayers were using real estate as a tax shelter. So they created the passive activity rules and said, yeah, we're not going to do that. We're going to make the assumption that all rental activity is automatically passive. And the only way to then create the situation where it is not passive, they then in the 1990s created the real estate professional status, which said, okay, we'll peel back the automatic passive limitation, and we will create a scenario where real estate professionals can actually convert that to where it is active. And that real estate professional status does not require licensing. Someone does not have to be a real estate agent or, specifically have, there's no licensing requirements. It's the time. But the short-term rental loophole, which was recently passed, is really where we're seeing a lot of traction. Whether the IRS jumps on this, it'll be interesting to see over the next few years, because this has become a huge play. But the requirement is the property has to have the average rental days that are 7 days or less. So if all of their renters throughout the year, they have to average at least 7 days or less. If they do, and this person who is managing the property does all of the significant personal services, so they don't have to do everything, but they do the majority of work, substantially everything relating to the property, then they can fall within any of these parameters. This one in the middle being the most common, which is that they have more than 100 hours a year and more than anyone else in the activity of managing their short-term rental. The short-term rental ultimately is a business. It's treated as a business instead of as a long-term rental. The asset is actually depreciated as 39 years instead of 27.5 years. So be aware that a short-term rental is not treated as residential because it's viewed more as hotel ownership. We actually get that. We'll do studies, cost-seg studies, and oftentimes have CPAs come back and say, you booked this wrong. This is 39. It should be 27.5. But the short-term rental does require that property then is treated as 39-year property because of the short-term rental designation. But within these parameters, this really opens the opportunity for many of these investors, and the strategy for these investors to buy short-term rental properties and then apply that against all of their W-2 ordinary income, and it alleviates the passive activity rules. So why is it considered a loophole? Well, it is in IRS publications. It has been upheld in several court cases. It's considered a loophole because at the time that it was written, they were intended for hotels and motels. The writers of the regulations didn't foresee things like Airbnb and VRBO. which has created an enormous marketplace for the short-term rentals, which now they can be managed remotely, they can be booked easily, and people can kind of manage them on any of their devices. So it is really crazy how all of this has come into play. But it is legitimate, and it is supported. We do see audits when it comes to verifying the activity, verifying that, either they're a real estate professional or they fall under the short-term rental loophole, verifying they have 7 days or less in nightly rents, and that they actually have the hours contributing towards their property management. So be aware of that. A couple of quick common mistakes with this, just as highlights. I kind of want to go through this because we're seeing so much and having these conversations constantly with clients. So we'll just kind of run through this quickly and then kind of wrap up with the application. But common mistakes: misclassifying property as a short-term rental. So really must make sure that it has the average stay of 7 days or less for the entire year. So that's really common mistake. Number two, misunderstanding that less than 7 days rule. Some investors think that they can achieve this by having one tenant sign multiple short leases. So we don't want to have workarounds. We don't want to work manipulating those. So again, as CPAs, advising clients on, look, if we want to follow the letter of the law, we want to take advantage of the tax code as it's written, but make sure that we're doing that from a defensible standpoint. Common mistake number 3 is ignoring personal use days. This is a big one. If the property is used for more than 14 days or 10% of the total rental days, it's considered a personal residence. We have a bunch of clients now who are renting out parts of their home, and then they want to depreciate the whole home or a percentage of the home, and then apply the short-term rental loophole to that. If they're using it for more than 14 days or 10%, that will not qualify. That's a big one. So if you run into that. Common mistake number 4, not tracking contractor hours, because they have to have 100 hours and substantially all of the time involved. So if they do a year with a large remodel and they have a contractor that's doing the remodel and spends more time on that project than they do, that could exclude them from claiming the short-term rental activity rules, the 100 hours. So that's a big one. Really looking at who's working on that and who's spending the most time on that project. Common mistake number 5, overlooking local regulations. And this one we're constantly seeing. I'm based in Las Vegas. Short-term rentals are completely banned in all of Las Vegas. Nobody's coming against the casinos, and they are not going to have competition from short-term rental owners. So understanding local laws, and we really encourage clients. So if you have clients all of a sudden wanting to dive in and buy their first property, just make sure that they have done their proper homework on what the local regulations are for those projects, because there is increased scrutiny almost daily on the short-term rental activities and allowances within many cities around the country. And with that, I had mentioned earlier that we can apply cost segregation retroactively with a Form 3115. It's a change of accounting method, and it does not require that the client has to amend. Therefore, they may have purchased a property 5 or 6 or 10 years ago, and maybe they couldn't use the depreciation at that point, or they weren't aware of it, or maybe it was passive at the time. And now they've had a change, and maybe they retired and they bought some more property and now they're active. They can actually apply the cost segregation now, utilize the Form 3115, which calculates the 481A adjustment. It's the catch-up that allows them to take that depreciation now on the current return and makes an adjustment back from day 1 up until now. That 3115 for depreciation method changes has automatic consent and no prior approval from the IRS. So these are automatically approved changes. It's a timing difference, and so they do not create added scrutiny. I think it's important because I still sometimes have CPAs who say, well, that's not allowable, or my client can't apply this. And the IRS does absolutely allow for these retroactive changes. So with that said, so many amazing opportunities for clients. We also do R&D tax credits with Tax Plan IQ. Many of these projects also have energy incentives that roll into their real estate projects that we identify as we're evaluating where those opportunities lie. But if you have clients who have any type of real estate, they're looking for tax strategies and deductions, or they're wanting to buy real estate for the sake of deductions, there are really many avenues and many incentives that relate to those projects and how they can apply those into their own taxable situation. And so with that, I would like to open it up for questions. My contact information is here and on the Tax Plan IQ platform. But would love to see if anyone has questions and open it up for further discussion.
We do have a few questions, and I think you might have answered this about for residential properties. Is there a particular, minimum as far as like dollar value of the property? I know you mentioned commercial, like unadjusted basis of 300,000. What about for residential?
Yeah, residential, it's really any size. I mean, we were looking at them, $100,000 properties. It really relates to what the taxpayer's income is and what tax bracket they're in. So we can see, is there enough meat on the bone for it to be worthwhile? I had a client, it was amazing. I did a call with a client who is based in Kentucky, and he's like, yeah, I've got 4 properties. And I said, oh, okay, what did you buy them for? So I bought this one for 25,000. I'm like, you can still buy property for 25,000?
Yeah, some states you can. Another question is about land valuations. You mentioned the 80-20, right? That's a reasonable, can you back into that a little bit? Like, is that a reasonable, would you say that's a reasonable allocation? Is there authoritative source or guidance for this? Or is it just
Yeah,
because that's
so
primarily
yeah,
practical?
so the 80-20 is what we have seen many of the CPA industry professionals use over the years. 20% is kind of the national average. When we look at the vast majority of states, cities, counties, the land average tends to be around 20%. It's very average. But my point on that slide is that using that standard allocation, we typically don't recommend doing that. That's where we see scrutiny. And if there is an audit, the IRS is going to come and say, where'd you get that? What do you have to back that up? So we recommend having substantiation, whether that's through an appraisal or the tax card, or some other documentation, rather than using the assumed ratio. So I just like to highlight that because we see a lot of CPAs still just saying, nah, 80-20 is fine. But that could be scrutinized if it's really skewed.
Right. Yeah, I usually like to start with the tax roll, right? Because that's guidance. Like that's what they're assessing, they're appraising the
Yeah,
land at. So that's definitely a more conservative approach that, would be substantiated in the event of an audit.
totally agree. Yeah.
What are typical fees for a cost segregation on a residential property? Or just
Yeah,
as a
that's a great question. Residential, we're typically between about $2,000 to $3,000 for a residential property.
okay. Yeah, because it's a formal engineer, like you mentioned,
Yeah,
process where you're
yeah,
dissecting every single thing.
yeah.
Okay, so that's
Yeah, usually with a physical site visit, usually about 3,000 kind of ballpark. Again, with a physical site visit, we can do virtual site visits. If it's a really small property that's remote, we can say, let's do a virtual site visit. We can do that with videos and record everything and still get a lot of great data. So that can be an option on some of the smaller remote projects.
okay. And then I think this goes back, you might have already answered this. Cabinets are I always thought cabinets were 5 or 7 year property, but you're saying, what do you guys think about cabinets?
Yeah, that's a good one. Built-in cabinets are considered part of the structure.
Mhm.
Removable cabinetry is considered 5-year property. So, like in my bathrooms, I have those, they look like furniture. They've got like freestanding legs and it's got the sink and counter, but you could I could move it. So it's actually based on the installation and how they built those. But standard like kitchen cabinets that are built into the walls and attached to the walls, those are actually part of the structure, cannot be put into 5-year.
Right, that makes sense because you can't, yeah, you can't like you're gonna have to take the wall if you take the built-in
Yeah,
cabinet. So like think of that, right? Like is it structure or is it removable that you can take them and you maybe use them somewhere else? That's I guess that's a good
yeah,
observation.
yep,
Um, so this is one of the users' comments. This is the best cost segregation webinar. I agree. I was like, wow, like cost segregation, everybody thinks they know everything about it. No, there's so many details that, you provided insight to that it's been amazing. Um, let's see. I think the question is like, what are the next steps? Like if they have a potential client contact you before, like what does a typical relationship look like, right? With the CPA?
yeah. So with CPAs, usually what people do is just, I mean, they just email me. We try to make it as easy as possible. So there's two ways to go about it. I'll tell you what typically works the best. If it's a property they've already filed a tax return for, it's huge because if you make an introduction, I'll respond to the client and say, look, we'd love to look at the property. We'll get some info first. Then let's have a call. We'll look at the benefits. If it's a property they've already filed a tax return on, we know we need the depreciation schedule. So then I have to request that and they have to go back to you to get that because most of them don't have it. So if you have a client with a project that they've already filed a tax return for, you could just make an intro, but send the depreciation schedule. That's all I need to do a benefit analysis because it's got the basis, the date, the prior depreciation, it's got everything. And I can run an analysis, get a cost benefit analysis done with a quote and the estimated depreciation. And then I'll schedule a call with them and walk through all those numbers. The proposal is also shared with you as the CPA so that you can really consult with how that applies to them and their personal tax situation. So, we like to correspond that way, just make an email introduction. But yeah, depreciation schedules are great. If it's a new property, just a closing statement.
I would probably recommend that CPA reach out to you, give you the information so you could give the CPA the benefit analysis and we could determine how we can, add it and price it into our tax planning services, right? Taking into consideration your third party fees. But that way the CPA is the first one to know about the tax benefits and what kind of tax benefits will together collaboratively be bringing to the client, right? And talk about like pricing. So I would definitely recommend you guys email her before bringing in the client, and then you guys go from there, just to
Yeah.
reflect those savings on the tax plan IQ. And
And
then
yeah, and it helps the client understand the process better too, because like I said, a lot of times they don't understand, and a lot of times they don't want to dig into the details. They're like, look, just tell me what the numbers are. So it's
right,
easier for us to just
yeah,
run the numbers and then go from there. And
okay.
I did see a question here. Brandon said, is the 2,000 to 3,000 for a DIY type software? Brandon, the 2,000 to 3,000 is for a full engineering study. So we do a limited scope that would be like $1,000. I do like 2 limited scope studies a year. We prefer not to do that. We want to do full detailed engineering on everything because of the details that I showed you. So that pricing is for a full study.
Great, thanks for that. And then the
Yeah.
last question, because I want to respect everybody's time and I want to thank you so much for being here, is are you close to Texas, or is it like you'll send out or you have professionals throughout the states, correct?
Yeah, we are nationwide. So I have teams all over the country. We do 600 site visits a month in all 50 states. I have site visit inspectors everywhere. So yes, we are doing hundreds of studies in Texas every single month, all over the country. So we do have feet on the ground, and that really helps with very competitive pricing.
Yeah, I appreciate that. All right. So the next step, guys, I know there's probably more questions. I recommend that you email her. You'll also find her information in the preferred vendors tab and in the cost segregation strategy under resources. So I would recommend the next step is you send her an email if you have additional questions. But definitely recommend visiting that strategy, learning more about that, or just getting in contact with her. So I want to thank everybody. Thank you, Heidi. Great presentation. Thanks for joining. Talk to you guys later. Bye.
Okay, thanks so much. Have a great day.